Welcome to Iron Financial, the place where we forge stronger portfolios by cutting right through the market noise. I'm your lead analyst. As always, I'm joined by our market skeptic. Today, we're putting a true titan under the microscope. The Chinese e-commerce giant JD.com just dropped its Q4 earnings, and let me tell you, the numbers sent some serious shockwaves through the market. Now, we're not here to just read you the headlines. Anyone can do that. We're here to run a full-scale financial stress test. We're going to determine if this company's foundations are built to last, or if they're starting to buckle under some pretty intense pressure. All right, let's get into it. So, the big question we're wrestling with today, it's absolutely critical for any investor who has skin in the game in China or even just the broader tech sector. I mean, on one hand, you've got a company that has been a gold standard for growth and just incredible operational excellence for years. But on the other hand, this latest report shows some really alarming figures, numbers that honestly suggest a company under siege. Our job today is to test the structural integrity of JD.com. We are going to examine the load-bearing columns, and we're going to look for those tiny hairline fractures before they turn into catastrophic failures. And to do this right, we've structured our stress test into 6 very distinct phases. First, we're going to survey the battlefield itself. We're talking about the brutal e-commerce price war happening in China. Then, we'll get right into the initial Q4 damage report, the numbers that have the bears circling and licking their chops. After that, we're going to dig past all that rubble to really examine the core business. Is the foundation actually still strong? From there, we'll calculate the high cost of this war by dissecting their spending. Then, we'll look at what I think is a crucial sign of management's confidence, how they're actually rewarding their shareholders. And finally, we'll deliver our verdict. Is this a huge value opportunity, or is it just a dangerous trap waiting to be sprung? Okay, let's kick this off with Section 1. Look, you just can't analyze a single fortress without understanding the war that is raging all around it. And the Chinese e-commerce landscape, it is not a friendly marketplace. It's a zero-sum battleground. And right now, the primary weapon of choice is price. And I'm not talking about just seasonal discounts here. No, this is a full-blown war of attrition, and it's designed to do one thing: bleed the competition and capture market share, no matter the cost. Yeah, and make no mistake about it, JD isn't fighting this war on a single front. It's facing what you'd call a pincer movement. On one side, you have the established behemoth Alibaba, a rival that is never, ever going to cede ground willingly. Then, on the other side, you have Meituan, which is an incredibly aggressive and powerful competitor in its own right. So what the source material is telling us is pretty clear. This fierce, nonstop competition is forcing JD's hand. It's pushing them into a very expensive and relentless price war that is touching every single line item on their financial statements. So the question isn't if there's a war. The question is who has the resources, the cash, and the strategy to actually survive it. And that brings us perfectly to Section 2. Now we're going to assess the immediate damage from this conflict. I'm taking the lead here because these are the headline numbers that have the market completely spooked. And you know what? Frankly, they look bad. This is the initial bear case, right? The first layer of concrete that we're going to have to drill through. So let's take a hard look at the cracks that are starting to show on the surface. The very first number that just jumps off the page is this one, an operating margin of negative 1.7%. You have to understand the sheer velocity of this drop. This isn't just a slight decline, it's a complete collapse from a positive 2.4% in the very same quarter last year. Just let that sink in for a second. A swing of over 4 percentage points, deep into the red. It tells you one thing very clearly. Costs are spiraling out of control while revenue is pretty much stagnant. And it immediately raises this massive red flag. Is management losing control of the ship? Can they really sustain this level of margin compression without doing permanent, irreversible damage to the business? So if that margin collapse was a crack in the foundation, this next number is a gaping hole in the hull of the ship, a net loss of 2.7 billion RMB. Now that is a shocking figure all on its own, but it becomes truly alarming when you compare it to the same quarter last year. Back then, they posted a net profit of almost 10 billion RMB. That is an almost 13 billion RMB swing into the red in just 12 months. This isn't a rounding error, people. This is the company actively bleeding cash. So for an investor, the immediate question is pretty simple. How deep does this hole go, and how fast are they digging? And this chart, well, it just drives the point home visually. You don't need to be a seasoned analyst to see exactly what's happening here. Just look at that solid green bar from 2024. That represents a healthy, profitable, strong quarter. Now look at the red bar for 2025, plunging deep into negative territory. This right here is the damage report, a swing from robust profitability to a significant loss. And it's all driven by a complete evaporation of their operating margin. From this perspective, the fortress appears to be crumbling. The bear case looks pretty airtight right now. Okay, hold on. The surface damage is undeniable, and you've laid out that bear case really well. But any good stress test has to go beyond what's superficial. So now, in Section 3, we need to bring in the heavy equipment and actually test the core foundation. Headline numbers can be incredibly misleading, especially when a company is making what it calls strategic investments. We have to isolate the main structure from all the scaffolding that's being built around it. So the crucial point is this. Is the core business, the part that has to bear all this weight, is it still solid? Let's drill down and find out. To do that, we first have to understand the company's architecture. This chart breaks it down perfectly. You can see the vast majority of the company's revenue, we're talking over $43 billion, comes from its core engine, JD Retail. Then you have JD Logistics, which is a significant and growing segment. And finally, you have the smaller slice for new business. Now, the press release explicitly says that the margin compression is, and I quote, primarily attributable to increased strategic investment in new business initiatives. These new businesses include things like community group buying and international expansion, which are notoriously cash-intensive in their early stages. So, to find the truth, we have to pull JD Retail out from the rest and see how that main load-bearing pillar is performing all on its own. And this is where the story gets really fascinating. Because when we put JD Retail under the microscope, we see two totally different stories play out. In the fourth quarter, yes, revenue dipped slightly by 1.7%, and the operating margin compressed a little bit, but only just barely, from 3.3% to 3.2%. That's practically a rounding error, not a collapse. But then, when you zoom out and you look at the full-year picture, the entire narrative changes. For all of 2025, the core JD Retail business actually achieved double-digit revenue growth, and its operating margin expanded significantly from 4.0% to 4.6%. So what this tells me is that the core engine isn't just holding up under pressure, it's actually getting more efficient and more profitable over the long term, even right in the middle of this brutal price war. The foundation is solid. And hey, you don't have to just take my word for it. This is a direct quote from the CEO, Sandy Zhu, right in the earnings release. She's confirming exactly what the data on the last slide just showed us. She calls the core business resilient, and she highlights the double-digit growth in both revenues and operating profit for the full year. Management is sending a crystal clear signal here. Don't get distracted by the short-term noise and the ugly Q4 headline numbers. The main fortress is secure and performing exceptionally well over the annual timeline. All right. I'll concede that the core retail business looks surprisingly durable. I'll give you that. But that doesn't answer the most pressing question. A fortress can have strong walls, sure, but if you're spending your entire treasury just to defend them, you're eventually going to starve. So for Section 4, let's focus on the exorbitant cost of this war. Is this spending really a strategic investment, like they claim, or are they just setting massive piles of cash on fire to hold the line? Let's analyze the cost. This slide right here reveals a massive disconnect. Just look at this. In the fourth quarter, marketing expenses skyrocketed by over 50% year over year. 50%! Let that number just hang in the air for a moment. And what did they get for that huge cash outlay? A mere 1.5% increase in total revenue. This is the textbook definition of diminishing returns. This right here is the primary source of that margin compression we were so worried about earlier. You simply can't spend money this inefficiently and expect to remain profitable. It really begs the question, is this sustainable at all, or is it just a sign of desperation? And it's not an isolated problem. This isn't just one rogue department that's overspending. As this slide clearly demonstrates by listing out the line items, the spending is happening across the entire board. Fulfillment expenses are up over 20%. R&D is up an incredible 52%. Even general and admin costs are up nearly 35%. The company is just opening the financial taps everywhere. Now, they claim this is all for new business initiatives, but these are staggering increases that are clearly dramatically outpacing revenue growth. This is the high cost of war, and it's being paid on every single front. You're absolutely right to point out the costs. They are immense. But there is another side to the capital story that we absolutely cannot ignore. In Section 5, we are going to examine what I believe is the single most important indicator of management's true internal confidence, and that's how they are deploying capital back to shareholders. Forget the forward-looking statements. Cash actions speak so much louder than words. If a company's leadership genuinely believes their strategy is working and that their stock is undervalued, they don't just say it, they prove it with their balance sheet. Let's start with this number. $3 billion. That's a massive figure. That is how much JD.com spent in 2025, just buying back its own stock. And look, this isn't some token gesture. This represents a huge 6.3% of the total shares outstanding. I want you to think about what that means. Management looked at all the possible uses for their capital, more R&D, more marketing, maybe some acquisitions, and they decided that the single best investment they could possibly make was buying their own company's shares on the open market. This is the ultimate vote of confidence. It's a clear, unequivocal signal that they believe the market is mispricing their stock and that the long-term value is significantly higher than where it's trading today. But they didn't stop there. As if the massive buyback wasn't a big enough statement, they also announced this: a brand new annual cash dividend, totaling approximately $1.4 billion. Now, initiating a significant dividend is a classic move for a company that is mature, financially solid, and completely confident in its future cash flows. Let me be clear, companies that are worried about bleeding cash and going under do not start billion-dollar dividend programs. This action directly contradicts the bear narrative of a company in crisis. They are telling shareholders, not only do we believe our stock is cheap, but we are so confident in our financial stability that we are going to start writing you a check every single year. Okay, so we've run the numbers, we've seen both sides of the coin. The cost of this war is alarmingly high, and the short-term damage is severe, no doubt. But the core business appears solid, and management is signaling supreme confidence with its capital return program. So this brings us to the final section, our verdict. We've put the company through the stress test, and now it's time to interpret the results. Is this a structurally sound fortress that's just weathering a temporary siege? Or is it an imminent collapse disguised as a value stock? Is it a true opportunity, or is it a trap? Let's just summarize the arguments one more time. The bear case, which I've been outlining, it's built on the hard, cold numbers of Q4. You've got collapsing operating margins, that dramatic swing to a net loss, skyrocketing expenses across every single category, and nearly stagnant top-line revenue growth. It paints a picture of a company that's bleeding money with very little to show for it. But the bull case is equally compelling. It rests on the proven resilience and, maybe more importantly, the full-year profitability of the core JD retail business. It points to strong growth in their other segments, like logistics. And it's all anchored by two massive, concrete actions from management: an aggressive $3 billion share buyback and the initiation of a brand new $1.4 billion dividend. So how in the world do we reconcile these two completely opposite narratives? So here's the bottom line. After running JD.com through our financial stress test, our final verdict is this: it's a battered fortress. The outer walls have been hit hard. The Q4 numbers show the clear damage from this price war siege. The collapsing margins, the net loss, that's the battering. It's real and it's ugly. However, our deep analysis shows the core structure, the JD retail business, remains incredibly strong, profitable, and is even growing on an annual basis. That's the fortress. And management isn't panicking. Instead, they are using their vast treasury not to flee, but to reinforce their own position through massive buybacks and to reward their loyal investors with dividends. So is it a trap? Well, for the short-term trader who's just looking for a clean quarter, absolutely. The battle is bloody and the costs are high. But for the long-term investor who can see past the smoke of a single quarter, what you have is a fortified market leader trading at a discount that is proving it can withstand a brutal siege while simultaneously rewarding those who hold the line. The fortress is battered, yes, but it is not broken.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.